Today is September 9th, 2025. I'm looking especially pale right now, today or tonight. So let's take a look. So, right now, what we're trying to do is find stocks. I'm going to do a little bit of searching to show you how I think we can find some stocks that are comparatively more likely to outperform the stock market over the longer period of time, 6 months to a year. So, let's first ground ourselves. We're on September 9th, 2025. It's 11:01 p.m. The S&P closed today at a nosebleed level of 6,512, which is a price to earnings ratio of 30.21 in the S&P 500. That is absolutely nuts in my mind. But so what we want to do is we want to find stocks that are more likely, that are valued at lower than the S&P 500, that are uh, ultra low debt, and that are growing faster than the S&P 500 in terms of their earnings that they're growing. So let's take a look at my favorite tool, which is yourshare.com or your-share.com. I've clicked on screener. I should tell you I'm partial to this site, in part because I built it for my own purposes, and it's been fantastic so far. I'll share with you some of that at a later time. Anyway, at a high level, what you can do is you can look through first at the screener here, and you can see, you can screen on all sorts of criteria that you normally wouldn't be able to share to screen on. And what your share means, all these metrics like Agilent Technologies, $35.15 of net income per 1K. What that's saying is if you invest $1,000 in every single one of these companies, and we've got 5,059 companies total, which are it's the universe of publicly traded and publicly listed on the various US exchanges, companies out there right now. And now you can compare apples to apples. Like if you look up Apple, Apple's right here, and it probably says it made $90 billion last year. That's great. What does that mean to you? If you put $1,000 in, what does that mean? Your share of the 90 billion or whatever the number is of earnings is. Well, it turns out it's about $29.28. That's what this column says. And what is, let's look at like its revenue per $1,000 invested. Well, I accidentally sorted it there. I shouldn't have done that. Let's go back here. I can look down and I can say Apple, for if you invest $1,000, you basically have invested in a miniature Apple company, and it says that you get $120.53 per year of sales. You can also see all sorts of other things like revenue growth. This is a compounded annual 10-year rate. 11.3% is fantastic, but we're going to actually shoot for even more. And before we do that, let me just show you some of the other things, because we're going to find some real bargains here. I think you'll be surprised. But one of the things is we can look at the evaluate tab, which I'm pointing at with my finger, but I'm also pointing with my mouse. That's if we want to just check out one single company. So like, let's look at Apple for an instant, just real quick. And let's check it out. So what this shows is first at the headline level, based on $1,000 investment in Apple, here's your share of the business. And you can change that. So if you want to, right here, if you want to say, I'm not going to invest $1,000, I'm going to invest $50,000, whatever the number is. Put in 50,000, click calculate your share, and it updates. So now your share of Apple income for a $50,000 investment is $1,343.60 for the last 12 months. But it gets way cooler than that. Trust me. Now we get to the graphs. And these are awesome. So first we can see how net income, your share of net income, has improved over time. And what we can see is that it started at $500,480.48.6. I'm going to change this back to $1,000 so it's more meaningful. It's the way I wrap my head around it. You can see for your $1,000 investment, you're going to get $4.16 of income based on prices when I last updated this. It's not updated for today's prices. It's as like a week ago, something like that. And so it's had strong growth in net income. You can see that it's generally up and to the right, but you can also see that starting in 2021, it was flat pretty much since then. 2022, 2023, 2024, it's actually declining over time, very slightly. It's just very flat. And you can do this for all sorts of stuff like cumulative net income growth. So this is saying you started 0% for all of it. It has increased its income over its total annual income by 180% over the last 10 years, which is a fantastic growth rate. But there are better things out there. So the price to earnings ratio at the time I did this was about 36. Apple's trading at 36 times earnings. That is absolutely nuts, given that it's a no growth company right now. We can look at its various compound annual rates of growth. I've messed that chart up, so just ignore that. Cumulative revenue growth, we can see it's grown sales by 163%, which means since it grew net income by 180%, that must mean that its operating margin has gone up a little bit over time. Let's see. So over time, yes, it has gone up. An operating margin is what they keep of every dollar after they subtracted all their expenses from operating income. We can look at their dividends, PE ratio. We can look at their net long-term debt, which is the debt less, and this is also not working right now. Well, don't worry about this. I'll show you a much cooler version. You can see all sorts of things. We can also see share count over time. You can see they have drastically reduced their share count over time. This is one of the huge things that's so fantastic about Apple. So they started, whatever the 2015 in this particular case is the baseline. Relative to that baseline, in the last 10 years, plus a few months, they have decreased their share count by almost 34%. The shares outstanding. That means you become a bigger shareholder over time for every dollar you invest. That's a fantastic thing. They're using their cash for that, much more so than dividends, because it's a tax efficient way. But let's start looking at some more interesting stuff. Let's click compare. This is where it starts to get interesting. So let's say let's compare Apple to Google. And I'll use the Class A shares, so GOOGL instead of a GOOG. Let's compare the companies. Let's see what happens here. Now we're going to start getting interesting. So we've got, these are the companies being compared. We've got Google in the darker blue and Apple in the not quite as blue. We can see how their net income is. If you put $1,000 in today, what your share of the income would have been each of the last 10 years. So you can see how it's grown over time. But a more meaningful thing, a couple more meaningful charts in terms of growth for net income are, let's first look at this one. This is the compounded annual rate of growth over the last 10 years. And you can see that Google has grown at 25, almost 26% net income growth. That's fantastic, phenomenal. And Apple only 12%. We can also see up here, Apple has stayed level over time. The last 3 years, they're just stagnant in the water. Maybe that's why Buffett's been selling off of it. Whereas Google continues to go up and to the right. Let's also look at earnings volatility. This is a measure of, I took all of the publicly traded companies of 5,000 companies, and I did a statistical analysis using a method that doesn't even matter here to measure the volatility of their earnings over time over the last 10 years. So if it goes just perfect in a straight line, that'd be the lowest volatility you could possibly get. And comparing to the other companies, this y-axis represents the percentile that they are. So Google's a 6.6 percentile of all companies, meaning it has some of the most stable earnings over time that you can have. And that's very important because it means a more stable, less volatile earnings means it's much closer to approximating a straight line over years. And you can feel confident that it's going to forecast out to continue to be that way. And you can see, so Google has lower earnings volatility. Apple still has good earnings volatility. Higher net income growth, and you only see 2 right now. So it looks like Apple's 0, but it's just a tiny little line because there are only 2. If I add another stock for comparison, let's say even bigger humdinger here, let's go with Meta. They are knocking it out of the universe here. So now they're in red, and so now we can see their growth as well. We can see Meta is actually the fastest growing of them all at 40% over the last 10 years. That is incredible. Anyway, and it has even lower earnings volatility. I mean, these two both are stellar, Google and Meta, based on these metrics alone. Let's keep scrolling, though, because there's all sorts of other stuff. And then there's valuation we need to talk about. Cumulative net income growth. This means you baseline it at 2015, 10 years ago, and then you see how much it's grown over time. Meta has grown its earnings, your share of earnings, basically earnings per share, by 2,000% in the last 10 years. Google, 687%, also incredible. Apple, 179.6%, which is nothing to sneeze at, but it's not even in the same league. You can see that the projection of growth for Apple is stagnant. It's basically 0 for the last 3 years. Whereas these other two are still very much up and to the right. And you can see it levels off a little bit here from 2024 to the TTM period. That's because this represents the TTM period only represents the first 2 quarters of the year. And so it's only half of their 2025 results. This is very much still up and to the right for both Google and Apple. We're going to get to the really cool stuff about how to find great stocks in just a minute from the entire universe of 5,000. But I just want to do a real quick scroll through here just so you can just see some of the incredible data you have here. So we can look at operating margin. Operating margin is a measure of what they're getting to keep as total profit. And what you would think, what economic theory would say is, that if they don't have a competitive moat where they can be competed with by other people, that operating margin is going to go down over time. It's going to go down because others are going to be able to get in there and compete and undercut them in pricing. And so you would see a going down chart. And we see that with lots of companies. However, with each of these companies, we actually see that they are maintaining or even improving their margin over time. You see a brief dip there for a year or two. From Meta, that's when we were doing the whole metaverse thing. It just didn't work out so well, but hey, at least they took a swing. Now we get a margin improvement. This is the same chart. So over the last 10 years, Google measuring from the beginning of the period to the end of the period, subtracting this from this, we can see that Google has increased its margin, net operating margin, by 6.86%. That is, for those of you out there who are the finance guys, operating leverage. It means that every dollar of revenue that you increase your sales actually increases profits by even more. It's leverage. It's fantastic. It's absolutely phenomenal. Each of these companies has that. Apple's barely been able to increase its margin over time. Meta tremendously, almost 10%. That is phenomenal. We can also look at this data over 5 years. We can look at dividends paid. Doesn't really matter here. Payout ratio of each of these companies, which is minuscule because none of these are really paying out a lot of their cash. They're either using it for buybacks or just stashing it on the books. We can also look at revenue. So let's look at revenue and how that has increased over time. It looks at its, based on this chart, like, well, they're sort of all the same. Like they all grew up and to the right. But they started with very different denominators. Like Apple started the year at 40, or 10 years ago at 42. $1,000 of your investment today would have bought $42 of earnings in 2015, whereas it only would have bought $23.29 of Google earnings and $8.39 of Meta earnings in 2015. Your $1,000 investment today. The shares representing the $1,000 that you buy today. So let's look at it to really see how much differentiated the revenue growth was between these three companies, because they're vastly different than just what this chart shows. We can first look at this chart. This is the basic one. This is the compounded annual growth rate, the CAGR, as some of you folks like to call it. We can see that Apple has only grown its revenue by 11% per year. Now, I say only, that's still pretty good, but there are a lot of companies that have done that over the last 10 years. And what we're going to ask ourselves at the end of this is, are they deserving of that multiple, the price to earnings multiple? Specifically, are they deserving of of a multiple that is a premium to the market? Remember, we just talked about how the market was trading at 30 times price to earnings, and Apple's trading at a higher price to earnings than that. But also, is the market justified in valuing $1 of their earnings more than $1 of Meta's and Google's, both of which are have vastly outgrown in the past and are vastly outgrowing today Apple? Here, this really starts to show it. The cumulative revenue growth, meaning start with the baseline of 2015 and grow it out. Meta has grown its earnings by 1,000%, Google by 450%, and Apple only by 162%. I say only, it's good, but it's not great. And so again, remember these numbers. So while the revenue growth for Meta and Google has grown by 20 and 30% respectively, the profit growth, which I'm scrolling up to here, is 2,000% and 687%, far higher. Why? Because of operating leverage, meaning their margin is improving over time. So anyway, I'm going to just very quickly scroll by some other things we can see. We can look at debt net of cash. So this is what you do. You take long-term debt and you subtract out the cash. Nobody's got any debt here. I mean, Apple's got a little bit, but it's minuscule compared to their earnings. We can look at the debt to EBITDA ratio, and this shows there is no debt there. I mean, these are all phenomenal balance sheets that we're talking about. A bunch of other stuff we can look at: cash, shares outstanding. Now, this is my favorite one of all. We can look at this first chart shows their average annual buy-in, like how many shares they've bought in of the float every year. And you can see Apple's dominating here. They're using that cash to buy in shares. About 4% of the total outstanding float every year is what they're buying in. That is phenomenal. And that also drives earnings per share growth and your share of earnings growth, because your share that you buy today will reflect 4% more earning of the total company than it did today, tomorrow, next year, and so on and so forth if this trend continues. Here we again have an overtime chart similar to revenue and net income that I just showed you. And what you can see here is that we're talking about baselining each of these companies in 2015, 10 years ago. And we can see that Apple has bought in almost 34% of its total float over the last 10 years. That is amazing. Google and Meta have some catching up to do. Google and Meta are each at around 8 to 10%, as you can see, but they're this slope has started to really change, and I bet they're going to buy in a whole lot more of their shares over the next few years. We can look at free cash flow. Well, here's one thing that's interesting: price to earnings. Now, this is as of not today. I haven't updated the data. I'm updating it now. But you can see that Google, despite, now it's had a bit of a run since I did update the data here. Maybe it's at like 25 now. But Google and Meta both grow much faster, have grown historically much faster, and appear to be poised to grow much faster than Apple. You would think that would mean that they would have a higher price to earnings ratio than Apple, but no, that is not the case. And so I'm going on record here right now, September 9th, 2025, saying, as between Google, Meta, and Apple, Google and Meta's price will increase 1 year, if we measure 1 year from today, September 9th, 2026, than Apple's. And the reason is you cannot continue, the market cannot rationally continue to pay, I don't know, I'm ballparking it, 20 or so percent of more for every dollar of earnings for a slower growing company, Apple, than they do for Meta and Google. There's more information here and everything else. And we could write an investment memo, which I'll show you some other time. But for now, I'll just stop right there. Let's go back to how do we find a good company to buy using our screener. So we go to the screener. And we're going to use some of these criteria here to determine what kind of companies we want to look at. Right now, we're going to look for a high growth company that has operating leverage, that's increased margin over time, that's got low or no debt, and that's reducing share count. Let's look at this. So we start with 5,059 companies. That's what we've got, 5,059 companies. Let's quickly weed some out. Let's start with net income growth. We do not want to look at any, for the purposes of this, any company that has not grown its net income per year on average over the last 5 years or last 10 years by at least 15%. So what's that take us to? We go from 5,000 companies to 436 companies. We also want margin improvement of at least 1% over the last 10 years. So now we go from 436 to 270. Now we don't want a PE ratio that's any higher than the market's trading at right now, which is 30. So let's do that. Now we're down to 202 companies. We want revenue to also have grown by at least, because of operating leverage, let's say at least 10%. So now we go from 202 to 100 companies. We haven't even gotten to debt yet or float. So let's keep going. We want their debt to EBITDA ratio, which is what's standard under credit facilities and everything else, to be, let's say, 1 time or less. In fact, let's say 0.5 times or less. So they're basically debt-free companies here. Why is that not letting me do that? I guess I have to do whole numbers. Maybe not. Bear with me here. All right. So that takes us down from 100 to 49 companies. And now we're getting to the cream of the crop here. We also want to find shares outstanding. Did I already scroll past it here? Growth in shares. So we want 0% annual growth or a negative growth. And now we go from 50 or 49 to 28 companies. We have gotten down to 28 companies. Now we're going to look at some of these. So here are some of the interesting names we've got. Adobe, Applied Materials, ASML. They're the company that builds some of the machines that Taiwan Semi uses to build GPUs and other things. So we've also got Coke. This is not Coke like Coca-Cola, the beveraging. It's the bottling company. We might look at that, but I'm just looking for some companies that I know here. This is a construction company that's in some ways exposed to housing, and I don't really want that right now. We've got Google. I'm going to go with Google with the L. It's priced cheaper and it has better governance rights. Let's keep looking here. Lamb Research, Lululemon. I can get up to 10 of them. So far I've gotten 6. Meta for sure. Pulte is a home builder. I don't like that. Texas Roadhouse. I'm not sure I like that. Let's look at, I've got 8 companies so far. So let's look at Simpson Manufacturing. Excuse me, what the heck? Let's also do Coke and Dick's Sporting Goods. Okay. So now we're going to compare selected. We're going up here and clicking compare selected. Now, each of these 10 companies are probably, if you buy them in an aggregate portfolio, I would go on record as saying they are very likely to outperform the S&P 500 as a whole over the next year or two. But let's see if we can cull this down a little bit. So let's first look for companies that have very high earnings volatility. So we can look and see all these companies have great earnings growth. And we have that, we know that because not only are the numbers here, and they are all phenomenal. This is 10 years compounded, but also because we screen for this. So it's not, shouldn't be surprised to us of this. We can also see certainly these companies are trading at substantial premiums to others, and we'll talk about that later in the price to earnings ratio analysis. Let's look at earnings volatility. We want, at a bare minimum, companies that have very low earnings volatility. In other words, it is way easier to predict a chart that just goes a little bit up each year, slow and steady, than to have one that goes all over the place. Like if I were to, let me delete this one and add a company that I know has some more earnings volatility, which is Progressive, which I like this company, but it has earnings volatility associated with it. So let's look for Progressive on here. We've got so many companies on here, it's sort of hard to tell. But you can kind of see it. So this is this kind of green color, and you can see it goes way up, and then it goes, if I'm following it right, goes way down, and then goes way up again. That is too volatile for me because I'm looking for simple. And let's see if it also reflects. It does. Progressive is on the 33rd percentile for volatility. That's still low, lower than average, but it's too high for my taste. So I'm going to eliminate it. And so I'll go up here and I'll delete Progressive. Now let's go down here again and let's look at the earnings volatility. Again, I'm using initial screens to figure out what I want to buy and what I don't want to buy. So DKS, which is Dick's Sporting Goods, it has high earnings volatility. In fact, slightly higher even than did Progressive. So let's go up there and let's delete that. Charts get, okay, so now we can see that pretty much everybody's going up and to the right pretty darn well. Looks like Coke might be a little bit volatile. Let's go down here and look. Oh, it turns out it is sort of volatile. I'm going to leave it there for right now, even though it is, at least a standard deviation or two higher than the volatility of all these other companies. But let's just leave it there for right now. Let's delete it. What the heck? Okay, now I think we've got all these companies growing like whatever grows fast. Weeds? I don't know. I don't know what to say. But earnings volatility, it looks like some of these are high now, but it's because they're at the 9th percentile. They're relative to one another, not to the entire universe of companies. And so we can again see that all of these companies have grown their earnings massively over the last 10 years. Like the lowest one has grown their earnings 629%. Your share of them, not just like in the aggregate, your share of them over the last 10 years, 629, it is mind-bogglingly good. Every single one of these companies, I would feel just fine. In fact, every single one of these companies, except for Lamb Research, is in my portfolio, and in substantial part because of this type of analysis right here. So let's look at operating margin now. Let's see if any of them were roasting along the bottom. Like let me add another company just so you can kind of see one that has Amazon. A very low operating margin. Now it's a different deal, and I'll add Dick's Sporting Goods back in just there too because I think they probably have a low operating margin. And I didn't screen for operating margin like just baseline. I only screened for improvement in operating margin to show that they have pricing power. But I could have also done a screen on the previous screen for the minimum operating margin that I was willing to accept. In other words, I don't want companies that are just scraping by, making 2 cents on every dollar that you sell that they sell. And here we can see in red, this dark red, light red, which is Amazon, that they have had massive improvement, but there was a period of time where they only kept 2 cents out of every dollar that they made in sales. That ain't good. And Amazon's an exception to every rule, but I would, under most circumstances, delete that. And I would also say this. I would say Dick's has a 12% operating margin, 10%, 11%. That's not terrible, but that's not what I'm looking for. I'm not looking for companies that have not terrible margins. I want them to have really substantial, sustainable margins. And this makes sense because Dick's is a retailer and they sell commodities in the sense that anybody else can also sell the same goods and they can engage in price wars, which is why I don't want Dick's. And for purposes of this, I also don't want Amazon. I'm not saying anything bad about these companies. I'm just saying I have a very specific list of criteria that I will and will not invest in. And this tool allows me to find these things. And so I'm culling the herd here. So let's scroll now down to margin improvement. Every single one of these companies has increased margin. And here's why that's important. You can predict with some accuracy, just looking, given how stable revenue growth has been over time with these companies. I mean, look, it's just up and to the right for every single one of them, different degrees, different slopes, but it's absolutely phenomenal. This also shows it. Every single one of them is basically, nobody except for Lamb Research had one down year, basically, but they're all growing revenue steadily every year. But here's the beauty of it. If you find two companies that are both growing revenue and one of them is also growing profit margins, that means that company grew its profits and can sustainably do that year after year, even faster than revenue. So if it can grow revenue by 10%, it might be able to grow earnings by 15% or 20%. This is operating leverage. It's absolutely phenomenal. It's a sign of a very healthy business. All these companies are fantastically healthy in growing their revenue. And their revenue growth rates have all been above 15%. The lowest one is Lamb Research and Applied Materials at 17.5% annualized. That is fantastic. Debt net of cash. Let's just make sure nobody's heavily indebted. So the most heavily indebted is, let's see, would be Adobe with $8. $8 of per $1,000 you invest. The way to read this is for $1,000 you invest, they're going to effectively go out in the market and borrow $8, which means almost nothing. Let's look at it in a more meaningful way, which is debt to EBITDA ratio. This is how credit facilities and indentures under notes, public notes, measure debt. And like a 3 times debt to EBITDA ratio would still be considered healthy. These companies have basically zero or not, or below zero, because they have no debt whatsoever, and they have cash, which these are all phenomenal. We don't have to worry about debt one bit. Whereas in the S&P and some other companies, like let's just look at a company that's heavily indebted just to see what it looks like. Energy Transfer. Oh, I guess I got to type in Energy Transfer. Weird. No Energy Transfer in the bar. I don't know what's going on there. Let's try another one. The Williams companies. Okay. Let's just see what real debt looks like when we scroll down here, so you can kind of get a sense of just how healthy all these other companies are. So Williams has actually negative growth in revenue, and they're totally flatlined. They've actually decreased revenue by 6% over the last 10 years. That's also a terrible sign. Debt net of cash is $348, which basically means if you were to buy Williams, they're a pipeline company, natural gas primarily, they would go out and every $1,000 you give them, they would borrow another $350 in long-term debt. Also a terrible idea. Debt to EBITDA ratio, you can see they're massively levered at 4 times earnings, whereas these other companies are basically at zero. So you don't have to worry about debt whatsoever. I'm going to go ahead and delete Williams because they don't work. I'm going to scroll down again. And now we're going to go into shares outstanding to make sure that we are getting not diluted. So look at this. Every single one of these companies is buying back shares materially every single year and decreasing float and increasing your share of the company. Your shares that you buy today will get you a greater percentage of the company year after year after year, so long as these companies continue on this pace. Here again, we can see every single one of these companies has bought back at least 8 or 9%. It says most dilution, but this is not dilution. That's just some kind of pre-programmed language. It should say least accretion, but it is accretive to you every year because your one share gets a bigger portion of the business every year as the pie shrinks. The number of pieces in it shrink by buybacks, and this is also tremendously healthy. Every single one of these, and I won't get into free cash flow. Now let's just talk for a second about price to earnings. So we agree that all these companies are fantastic. Like, how much of each of them should we buy? Should we equal weight them? And then here's how I look at this. I look at this like, one, they need to all be below the price to earnings of the S&P 500, because now I have a number of tremendous safety margins of safety in my investment. One, I'm diversifying across a number of companies. Two, there is no debt on these companies. And so in really bad times, they're not going to go bankrupt. A certain portion of the S&P 500 will be heavily indebted and experience negative leverage from reduction in sales. Their debt will go up tremendously. And that's a very bad thing, a very dangerous thing that none of these companies are exposed to. Three, All of these companies are increasing. They have pricing power in the market. We see that through the gross margins or the operating margins and the increase in operating margins over time. Four, all of these companies are increasing revenue every year, year after year, materially. So even if there's a slowdown, I feel confident that they will continue to grow faster than the S&P 500. But they trade at different valuations. For instance, Lululemon, which has had some rough times lately, trades at a lower, and I think it's even lower than that now. I haven't updated the numbers in a little while. Trades at a price to earnings that's one half, roughly, of what Meta's price to earnings is, which means I would pay $2 or double as much for every dollar of Meta earnings that I'm buying than Lululemon. And I have to ask myself, is that justified? And the way I look at this is more art than science, but what I would do is I would say, okay, knowing what I know about these companies, and I also screen for only companies that I know what they do, I would say, okay, I'm going to look at the net income growth of each of these companies. So Lululemon has historically grown its earnings at 25% per year over the last 10 years. Meta has grown it at 40%. And when you compound that over time, it's vastly more. I can just show you. So Lululemon has grown its earnings 670%, whereas Meta has grown it over 2,000. I am not in any way saying that these growth rates are going to continue. I'm sure they're not, although I really wish they would. But I do think they're an accurate reflection, and particularly the slope on them, the growth in them over the last couple of years, to reflect what's going to happen in 1 year and in 2 years. Like Meta is going to continue to grow very quickly, is what I think here. And I can say that for all of them, but I think Meta is going to grow quicker. So I think it's justified that Meta trades at a premium, although still a discount to the market, relative to Lululemon as an example. And my answer would be yes. At this point, I think you can equal weight them. I've done that sometimes, but I'm experimenting with various things. I haven't done enough back testing to be able to tell you the best. What I'll tell you, what I do whatever you want. This is not investment advice. None of this is I go with the companies that I'm most confident in that are going to grow, that I'm most confident are going to grow over the course of the next year at a higher rate than the market. Right now, that is, of these, it would be number one and two would be Google and Meta. And so I weight them higher. With respect to ASML, I've done some interesting analysis on them relative to Taiwan Semi and NVIDIA. And this is for a different video some other time, but I found that they have a very high correlation between those three in terms of sales and in terms of profits and in terms of volatility and other metrics as well. But ASML trades at a cheapest price to earnings typically, at least relatively recently. Taiwan Semi trades just a little bit richer than that. And then right now, NVIDIA trades like way higher than that, which is absolutely crazy, given that they have very, very similar growth profiles. And I'll show that in a later video. But I just wanted to show this to you so you could start looking at this yourself and maybe make some judgments on what you're buying based on your share of the company's earnings.